Warren Buffett's annual letters to shareholders are legendary, but the one from 1996, it's something special. It's way more than just a financial report. It's really a timeless playbook for how to think about business, value, and investing. So today, we're going to break down the masterclass he gave in that single pivotal year.
So let's start with the headline number from 1996. It was just staggering. Berkshire Hathaway's net worth shot up by $6.2 billion. That's a 36% jump in 1 year. But here's the crazy part. Buffett himself, right in the letter, tells everyone to look past that massive number because it's not the one that really counts.
And this quote right here, this is the heart of his entire philosophy. He's basically telling his partners, that's what he calls his shareholders, to look deeper. Forget the standard accounting number of book value. The real scorecard, he says, the true measure of success is a company's intrinsic value.
So this brings us to the first big idea from his 1996 playbook. You've got to understand the difference between what the accounting books say a business is worth and what it's actually worth.
Okay, so what's the difference? Well, book value is pretty simple accounting. It's just assets minus liabilities. It's like a snapshot in the rearview mirror. But intrinsic value? That's all about looking forward. It's an estimate of all the cash a business is going to spit out for its owners over its entire lifetime. In short, it's what the business is truly worth. And for Buffett, that is the only number that matters. Right, so if growing that intrinsic value is the main goal, then what's the engine that makes the whole thing go? For Berkshire, that engine is something Buffett basically calls a financial superpower, insurance float. Seriously, if you had to pick just one thing, Berkshire Hathaway's single greatest advantage, its secret weapon, what would you say it is?
Well, the answer is hiding in plain sight, right at the core of their business model.
And that secret weapon is called float. It's a remarkably simple, kind of genius concept. See, when you pay your insurance premium, the company gets to hold on to your cash and invest it for themselves. They only have to pay it back if you file a claim down the road. That giant pool of money, all those premiums they've collected but haven't paid out yet, that's the float. And the sheer scale of this is it's mind-boggling. Just look at this growth. From about $17 million in 1967 to over 6.7 times billion dollars by 1996. But here's the real kicker. Look at the cost of those funds, less than zero. What does that mean? It means their insurance businesses were so profitable that Berkshire was literally being paid to hold and invest billions and billions of dollars of other people's money. I mean, come on, that is a true financial superpower. Okay, so you've got all this capital coming in from the float. How does Buffett decide what to buy with it? Well, 1996 gave us two perfect examples, and they show us that for him, it's a lot less about spreadsheets and a whole lot more about people.
And here it is, straight from the man himself. He lays out the two non-negotiables. You need a great business and you need a great manager. It's not one or the other. You absolutely have to have both.
So first up was a company called Kansas Bankers Surety. Now, this wasn't some huge, flashy deal, but Buffett called it an attitude treasure, all because of its manager, a guy named Roy Dinsdale. He saw a man who just loved the business and knew every single detail. The deal was basically a bet on Roy. The second deal was way bigger. Flight Safety International, a $1.5 billion acquisition. And get this, the idea didn't come from some investment banker on Wall Street. It came from a longtime Berkshire shareholder who just knew the two companies would be a perfect match. And the story of how this deal actually happened is just pure Buffett. He meets the company's founder and CEO, a 79-year-old guy named Al Olchi. And as Buffett wrote later, about 60 seconds into their conversation, he just knew Al was his kind of guy. There was no army of analysts, no months of due diligence. It was a handshake deal sealed by an instant judgment of character. Just incredible. Now, this focus on great managers and great businesses, it all points to a bigger part of Buffett's philosophy, investing in what he calls the inevitables. But as the 1996 letter also shows, even when you're hunting for a sure thing, you're still going to make mistakes. So what are these inevitables? Well, they're businesses with a brand and a market position that is so powerful, their future success is almost a foregone conclusion. Think about Coca-Cola or Gillette back in '96. They were so dominant, you could pretty much bet their earnings would keep growing for decades. That's the kind of business he's looking for. But what happens when you swing and miss? For every home run like Coca-Cola, there's a mistake. And for Buffett, one of his biggest was his investment in US Air. I love this because he doesn't pull any punches. In the letter, he's just brutally honest about his screw-up. He admits he totally misjudged the awful economics of the airline industry. He said it was just way too competitive and you had to pour in huge amounts of money just to tread water. It's such a powerful lesson that even the greatest investors get it wrong sometimes.
And this brings us to the last big takeaway from the letter: Buffett's deep, deep commitment to his shareholders. He doesn't see them as speculators, he sees them as partners. And in 1996, he made a huge move to protect them.
See, here was the problem. By the mid-90s, a single share of Berkshire stock cost tens of thousands of dollars. That priced out almost everybody. So Wall Street saw an opportunity. These firms started creating unit trusts, where they'd buy a share of Berkshire and then sell tiny little pieces to the public, for a huge fee, of course. Buffett saw this as basically preying on small investors.
So he fought back. Berkshire created Class B shares, which people started calling baby Bs. They were priced at 1/30th of a regular share. And the goal wasn't to raise money. Nope, it was explicitly to give regular people a low-cost way to become partners in Berkshire for the long haul, cutting out those middlemen and their ridiculous fees. In the end, this entire playbook, everything we've talked about, it really boils down to this single piece of advice. Your goal isn't to outsmart the market or chase the hot new thing. It's to buy a piece of a great, easy-to-understand business at a fair price and then just hang on. It's a simple strategy, but as Buffett himself would say, it's definitely not easy.
And that's what's so powerful. That wisdom from 1996 is just as true today as it ever was. Buffett loves to talk about finding economic castles protected by these huge, unbreachable moats. So let me leave you with a question. What company today fits that description? What business out there is so dominant that its success, say 20 years from now, seems almost inevitable?